Like I say, thank you all for your time this morning. Thank you for attending our latest webinar. This is now the fourth webinar that we've done this year. The other ones are all recorded and available on our YouTube channel. So if you want to go back and look through them, just go onto YouTube and search RTS Financial Planning. Okay, just before we get into the webinar, the usual risk warnings. We're going to be going through financial information, and I'm going to be presenting guidance on various financial matters, but it is just guidance only and not advice. So if you do want to explore any of these topics in more detail, I'll urge you to contact a qualified financial advisor. As we go through the webinar, do feel free to ask questions. There is a Q&A box, I think, at the top of your Zoom panel. So if you feel a question coming on, just type it in there. And what we'll do is we'll try and get to the questions at the end, and I'll answer as many as I can. And if I don't have time to answer them all, I'll come back to you all separately. Please stay till the end of the webinar, because everyone on this webinar today qualifies for a free inheritance tax assessment, which we'll put together for you. So I'll just explain how to go about getting that assessment at the end of the webinar today. Just a real quick bit about me, the presenter today. My name's Carl Roberts, and for those of you who don't know, I am a qualified, registered and practicing financial advisor. I've got a law degree, I'm a chartered financial planner and also a fellow of the Personal Finance Society. And I'm the founder and managing director of RTS Financial Planning, which is a financial advice firm specialising in investment management, wealth management, particularly for people approaching retirement or in retirement and are really looking to sort of grow their wealth for them and their family to enjoy. Okay, so inheritance tax. In last year's budget of March 2020, the Treasury estimated that by the year 2024, they will collect 6.7 billion annually in inheritance tax receipts alone. And this was before the latest budget, where it was announced that certain inheritance tax allowances would be frozen. And this is a big problem, and it's a big problem for your loved ones, because inheritance tax must be paid before your beneficiaries can access your estate. So when you die, there's a process called probate that your beneficiaries and your loved ones will have to go through to prove, if you had a will, who the beneficiaries are, how much money you've got. But before they can get their hands on any of your money, they must pay the inheritance tax bill first. So let's just take a step back and determine what inheritance tax actually is and how it's worked out. So when you die, your estate is everything you own that you leave behind. And this is a bit of a jargon term that is used when dealing with inheritance tax. So we always talk about your estate, and we don't just mean your home. So your estate is not just your home, it's everything you own. It's your money, it's your savings, it's your investments, any cars you own, jewelry, houses, and potentially even a business. And inheritance tax is paid on the value of the estate that you leave behind. And it can also apply to some of the gifts you make before you die. Now, luckily, there are a couple of allowances that the government gives us, which means that there's an amount of your estate that is not subject to inheritance tax. So it's a bit like income tax, where you're allowed to earn a certain amount of income before you start paying any income tax. It's a little bit like that of inheritance tax. You're allowed to be worth a certain amount of money before inheritance tax will actually apply. And the main allowance that we all have is called the Nil Rates Band. So basically everyone gets an inheritance tax-free allowance of £325,000, and that can be used against anything you own. So if you're worth less than 325,000, then you probably don't have an inheritance tax problem right now. The second main allowance is called the Residence Nil Rate Band. And some of you on the webinar today may remember the Conservative Party 2015 election pledge, where it was reported a lot in the news that they were going to ensure that no one paid inheritance tax under £1 million. So if you had £1 million estate, you'd be safe from inheritance tax. And when they got elected, they did kind of bring this feature in, but they made it very complicated, which we'll sort of go through and try and explain now. So basically, the residence nil rate band is £175,000 per person. So this is on top of the nil rate band that we've just described. And it's applicable to the family home, so your main residence. And in order to qualify for the allowance, you must own a property and it must be left to direct descendants. So what that means is it has to be left to either your children or your grandchildren or their children. It can't be left to parents or friends or nephews. And also the rest of your estate must be worth less than 2 million, because if your estate is worth more than 2 million, you start to lose the residence nil rate band. So yeah, the Conservatives did bring in some additional allowances, but made it very complicated. Now, your marital status will have a big impact on the level of inheritance tax you may or may not pay. So basically, any assets that you leave to your spouse or civil partner are exempt from inheritance tax regardless of value. So if you have a typical will, a typical standard will, whereby you leave everything to your spouse or civil partner and then to your children, well, on your death, if your spouse survives you and they inherit everything, there'll be no inheritance tax implications at that stage. So you could be worth 10, 100 million. If you leave it all to your spouse, there's no inheritance tax at that stage. Also, you can transfer your nil rate band allowance to your spouse or civil partner when you die. So if you do leave everything to your spouse or civil partner, you're not actually using your nil rate band. So your spouse or civil partner can actually inherit that nil rate band off you, meaning that then on their death, they have a combined nil rate band of 650,000. And what is the inheritance tax amount? Well, that's where it is fairly simple. It's 40%. So nearly half of everything you own after these allowances can be lost to inheritance tax. And remember that you've already paid income tax, national insurance, VAT, stamp duty, and potentially capital gains tax during your lifetime. But still, the government want more when you die. So let's just put this into perspective with a few examples. Here we've got a married couple with children. So they have a house worth 850,000. They've got some cash savings, 100,000, and some investments, 500,000. So bringing a total estate, a combined estate of 1.45 million. Now, because they've got children and their estate is worth less than 2 million, they both qualify for their residence nil rate band. So two of those comes to 350,000. And also they qualify for their nil rate band. So two of those come to 650,000. So you see, this is where we get to the £1 million that the Conservatives were talking about. 350,000 plus 650,000 comes to £1 million. So that's £1 million worth of allowances that this married couple have. So actually, out of their £1.45 million estate, only 450,000 is liable to inheritance tax. So if they were to both die, the actual inheritance tax bill on this estate would be £180,000, which must be paid, remember, before the children can access the rest of the estate. If we look at another example, this time a single person with no children. So this person has a house, their home worth 500,000, £50,000 in cash savings, and £300,000 in investments, bringing their total estate to 850,000. Now this time, this particular person doesn't qualify for the residence nil rate band because they don't have any children. So there's no linear descendants that they can leave their family home to. So that allowance has been taken away from them. They're not married, so they've only got one nil rate band. So they do still have that 325,000 that can be used to offset their estate. So even though their estate is worth 850,000, once you take off the nil rate band, the amount liable to inheritance tax is 525,000, which at 40% tax is a £210,000 bill. So what's really interesting on this one, you've probably spotted, is that the single person's estate here is worth far less than the previous married couple we just showed you, but yet their inheritance tax bill is higher. So some sibling or niece here might think, wow, thanks, Auntie Margaret. But actually, they need to pay this £210,000 bill first. So hopefully you can see, inheritance tax is a big problem, and it's a problem not everyone thinks about because obviously it mainly applies when you die. But this is, wealth that you're building, serious wealth that can be taken away just because you've died. But thankfully, there is some planning we can do to try and reduce the inheritance tax bill or perhaps avoid it altogether. And there's basically 4 main ways to save some inheritance tax, which we're going to run through now. And the first of these planning methods is the really easy one, is just to go out and spend your wealth, because the government obviously can't tax what isn't there. So hopefully, if you put a plan together, that means you can sort of spend happily, you don't leave too much behind, and obviously then hopefully your estate can be under various allowances and then you won't have to pay any inheritance tax. And obviously a lot of the work we do is we help sort of clients realise this. We help them perhaps retire early, perhaps spend more than they previously were thinking of doing, and particularly when you highlight the implications of paying inheritance tax. I mean, some clients you will meet and they work very hard during life and they're very passionate about leaving a very big legacy for their family, and there's nothing wrong with that. It's just understanding the inheritance tax implications of that. Whilst others, obviously, they love their children dearly, but they've worked hard for their money and they want to enjoy it and spend it, rather than giving a good chunk to the government before it goes to their children. So spending it is obviously definitely one planning avenue you've got to reduce your inheritance tax bill. The second planning method is, rather than spending it on yourself, gifting your money to other people. So the gifting planning route is fairly easy to understand. You can give anything you want away to any person you like. You just need to be careful that you survive 7 years, because if you gift something to another person, yes, it becomes out of your estate and is potentially not subject to inheritance tax, but it will be brought back into your estate if you die within 7 years. And potentially then inheritance tax could be due. Now, there is a very small £3,000 per year per person gift allowance. So you can give away £3,000 in gifts in any one tax year, and you won't pay any inheritance tax on that, regardless of when you die. So even if you die within 7 years, if your gift was under £3,000, then there won't be any inheritance tax. And there's some other very small gift allowances that you're able to give away for birthdays and weddings, which again, you don't have to worry about surviving 7 years. So rather than spending money on yourself, you might want to consider gifting money to your children now, so you can see them enjoy it, but also you're reducing your inheritance tax bill, rather than waiting until you've died before your children and loved ones inherit. But part of the problem with gifting is that it's usually irreversible. So once you've gifted money away, if you find you need more money in your future, it's unlikely you're going to be able to get that money back. You also then can't control what happens to the gift. So if you wanted it used in a certain way, once you've given it to that person, you've got no control on what they actually do with it. And like we said earlier, it's your loved one's problem. The person receiving the gift will pay the inheritance tax bill if you die within 7 years. So they might really thank you for giving away a large amount to them, perhaps giving away money to children to help them with their buying their first home. But your children might not thank you if you die within 7 years and then they're stuck with an inheritance tax bill. You could give to people, but you could also give to charity, and this is where it's slightly more simple. You can give any amount to charity and there's no inheritance tax implications at all. So you don't need to survive 7 years. As soon as you've given money to charity, it's outside of your estate and therefore is not subject to inheritance tax. And actually, if you leave 10% or more of your net estate to charity via your will, then it reduces your overall inheritance tax rate by 10%. So rather than paying 40% inheritance tax, you pay 36% inheritance tax on the rest of your estate if you leave 10% to charity. If you are gifting and giving money to charity, always remember to use gift aid, because that will also reduce your income tax bill as well. So gifting is another really good way of reducing your inheritance tax. The third method is using an insurance policy. So basically taking out a life insurance policy whilst you're alive, which is there to pay any potential inheritance tax bill when you die. So this can be quite useful for people that want access and control over your money, because if you need your money for your retirement income, obviously you get to keep the money in this planning scenario, but you know you've got an insurance policy there to pay the inheritance tax bill straight away. So it takes that stress away from your loved ones having to find the money to pay the bill, because you've already got an insurance policy in place. If you do go down this route, I really must urge you to put the life insurance policy into trust. Now, most insurance companies will recommend doing this, but it's vital that you do, because if you don't put your life insurance policy in a trust and it gets paid out to your estate, well, actually, you've just increased the inheritance tax bill by adding more wealth to your estate, and your loved ones can't access the policy proceeds. So do write that into trust. You don't just need an insurance policy for when you die and your total estate. You can actually use small mini policies for the gifts you make. So if you make a large gift, perhaps again to your children to help them buy their first home, you can set up a policy that runs for 7 years to protect that potential inheritance tax implication of dying within 7 years, and then your beneficiary having to pay inheritance tax on the gift. The problem with the insurance planning route is that obviously the older you get, the more likely you're going to have some form of ailments. You're going to have to go through medical underwriting, and that could mean that the insurance policy becomes quite expensive. And whilst it is a very handy tool to have up your sleeve, it doesn't actually reduce the inheritance tax bill. You're just having a separate method of paying it. And finally, the fourth way of protecting against inheritance tax is to look at inheritance tax friendly investments. Now, there are investments out there that if they qualify for something called business property relief, they can be inheritance tax free after 2 years. So providing you've held the investment for 2 years and you die holding the investment, you won't pay any inheritance tax. It won't even be included as far as inheritance tax calculations go. And the beauty of this approach is that obviously you keep access and control over your wealth. So you, rather than parking your money in a sort of a bog standard ISA investment, you might go for an inheritance tax friendly ISA that qualifies for business property relief, and you're actually still able to access that money. The money's still going to grow, it's invested, but you can also make some really good inheritance tax savings. And the downside to this approach is that obviously your money is still invested, so there's always that stock market volatility. It tends to be that if you use investments that qualify for that business property relief, they will be generally smaller companies, so perhaps more riskier than the traditional stock markets. But if you look at it another way and think you're due to lose 40% of the money via inheritance tax anyway, how risky is it that you invest into something that qualifies for business property relief? Sometimes access can't be guaranteed, so the more sort of high risk you go with some of this stuff, you're not always able to get your money back out straight away, so you do need to be careful of that. And there's always the danger that the government change the tax rules in the future. So whilst they're quite happy for business property relief to be free of inheritance tax, yeah, there's nothing to say they won't change that in the future. So basically, when it comes to planning against inheritance tax, you've got 4 key planning methods there, but it's usually a combination of all 4 that works to really drive down your inheritance tax bill. But there's actually one tool that is probably the single best inheritance tax planning tool out there, and you've probably already got this tool in place. And that's the humble pension. So back in 2014, the then Chancellor, George Osborne, announced something called pension freedoms. And when it came into force in 2015, people basically had full control over their pensions and could do what they wanted with them, including taking a whole lot out in one go if they wanted. But what is not often reported is the brilliant changes that happened for pensions and inheritance tax. So, really simply, if you were to die before age 75, there is no inheritance tax due on your pension. So the value of your pension is not added to your estate for inheritance tax purposes. And also, if you die before age 75, there's the added bonus of there being no income tax for the beneficiaries of your pensions. So your beneficiary can inherit your pension, take whatever they want out of that pension, and it's completely inheritance tax free. So it really is the best inheritance tax planning tool you can get. So much so that it used to be the case that when you retired, obviously your pension was the big fund that you're going to start using for your income in retirement. But nowadays, we find that most people will want to leave their pension till last because of the brilliant inheritance tax planning features of it. If you do die after age 75, there is still no inheritance tax to pay on your pension. The only change is that your beneficiaries pay income tax at their marginal rate. So depending on what they take out of your pension, it'll be added to their other income and they'll pay their own bit of tax on it. So a really fantastic inheritance tax planning tool is the pension. You do need to be careful that if you die, the pension does need to be transferred or benefits paid out within 2 years of your death. If not, then inheritance tax could be due. So we've gone through some planning methods. So we know there are ways to avoid inheritance tax. So that's great. We can get that 40% rate down and protect lots of your wealth. But are you someone that worries what your kids will do with all the money or your beneficiaries will do with all the money once you're gone? So even though you've saved them a load of inheritance tax, are you still worried what they're going to do with it? Are they going to buy sports cars, yachts? Are they going to do a lot of partying? Are your children still relatively young and yet to forge their path in life? Because remember, you only have to be age 18 to legally inherit. And I'd say, being 18 now is still fairly young to be responsible for, a loss of money. And also, what about, if your children or beneficiaries get divorced in the future? If you've got grandchildren, what happens to their inheritance? Because obviously, if your children were to get divorced in the future, it could be that 50% of your wealth is lost to the ex-son or daughter-in-law. And then if the ex-son or daughter-in-law remarries and has children with the new partner, it could be your wealth going down a totally different bloodline. So thankfully, there is something we can do about this as well. And that's by using trusts, which are brilliant at giving you some form of control from the grave. So without going into the real technical details of trusts, to keep it simple, all a trust is a legal document, a bit like a will, where you state who you want as trustees, who you want as beneficiaries, and give them some guidance over what you want to do with the money. And then money held inside a trust is outside of your estate. It's outside of your beneficiary's estate. And it belongs and managed by the trustees. So trustees are people that you choose, so just people that you trust to run and manage that money for you on your behalf when you've gone. But what it means is that because the money is owned by the trust rather than your son or daughter or one of your loved ones, it can't be used in any divorce proceedings. If your beneficiary was to go bankrupt, it can't be used. And also, really importantly, for care fees. So if your children or beneficiaries needed care in the future, the local authority can't use the money in the trust fund to help pay for care because it's protected. It's totally separate. It's a separate legal identity with the money being in a trust fund. So a really good way to protect your wealth after you've gone. So one question we get asked quite a lot is, when is the right time to actually plan for inheritance tax? We've gone through some scenarios today and we know it's a big problem, the inheritance tax bill. So when actually should you be looking to put some of this planning in place? Well, with any financial planning, it's always a balance. And there's probably a couple of steps that you do need to go through before you actually start really focusing on inheritance tax, because there's no point locking your money away, gifting your money away, if it means you've got nothing for retirement, for example. So usually you always want to sort of focus being secure in your home first of all. So you want to be able to afford the lifestyle that you want today. You want to ensure that you've bought your family home, your forever home, you've got that, so you're not saving towards that anymore. So that priority is ticked off. Then you also want to look at your sort of protecting your family. So ensure you have the right protection policies in place so that there's enough income, enough money there that should something happen to you, your family are looked after. So that's a priority you want to deal with first. And then, of course, the big one, your retirement. You want to ensure that you've got enough income in retirement to cover your lifestyle that you want to leave. And I think once you've done those steps, that's when you really can be starting to look at inheritance tax and planning against that. Because if you know you've got enough money to sort of live the rest of your life, if you've got excess, then that's the excess money that is going to start to be attacked by inheritance tax. So that's the money you want to use to start planning against inheritance tax. So just to summarize what we've gone through this morning, inheritance tax is a big problem. Luckily, there's 2 allowances that we can use before we pay any inheritance tax. But remember, the residence nil rate band in particular is complicated and not everyone gets it, particularly if you don't have children. The bill itself, inheritance tax, 40%, so it's nearly half of everything you own after allowances can be lost to inheritance tax. And remember, it's your beneficiaries, it's your loved one, children's problem. They're the one that need to find the money to pay that inheritance tax bill. We went through briefly the 4 main ways to save the inheritance tax. So spending it, gifting it, insuring it, or investing it. And actually, the pension is one of the best solutions to protect your money from inheritance tax. And if you are someone that is concerned and you want some form of control over your wealth once you've gone, then trusts are a great way to do that. And ultimately, like anything in life, you just need to have a plan. You just need to know where you stand and what you need to do to protect yourself against some of this stuff. So I hope that's a useful introduction to inheritance tax and some of the planning methods around it. I said earlier, obviously, that everyone today, if you're worried about your inheritance tax situation, we're willing to do a free inheritance tax assessment for you. So we will just run through your estate and tell you what your current inheritance tax bill is and what you should be watching out for. So in order to put this process in motion, I'll be sending out an email later on today with a recording of the webinar and also a link to book into the diary, a short phone call, so we can just run through your estate and then put that report together for you. So just look out for the email later. Okay, so we've got a bit of time for questions. If anyone's got any questions they'd like to ask on some of the subjects we've gone through today, please feel free to tap that into the Q&A box now. And I'll just have a quick look what's come through. Okay, so yeah, one question here we've got, is there any inheritance tax paid on money left to my non-married partner if we have kids and been living together for over 10 years? Okay, so yeah, this is a really good question. So if you're not married, it can potentially be a problem. So if you're not married and you have an estate worth well over the inheritance tax allowances, if you leave all of the money to your non-married partner, potentially they are going to pay some form of inheritance tax. So you don't really get any favour with the government just because you've got kids together and you've lived together for a long time. You're just treated effectively as two separate single people. So if you were to leave all your money to your non-married partner, you would be using up your allowances first. So you would be able to use them. But if you've then left wealth over and above those allowances and it's left to your non-married partner, they would potentially have inheritance tax to pay. So it's only marriage or marriage or being in a civil partnership that means there's no inheritance tax. Okay, and then another question that's come through here is, can I give away my house to my kids and avoid inheritance tax if I survive 7 years? We get this question quite a lot. This is a really kind of common question that's asked. So yes, you certainly can give away your house to your kids and avoid IHT if you live 7 years. However, you have to be careful of what's called gifting with reservation. So if you're to make a gift to someone, you have to gift that gift outright and not receive any benefit back from it. So if you were to give away your house to your children, you would need to pay a market rent to them for staying in that property. And if you did that and you survived 7 years, then that would potentially all work and not be subject to inheritance tax. But if you continue to live in the property and you don't pay any market rent, then what the HMRC government are going to do is they're just going to say, well, that wasn't actually really a gift. You're just trying to avoid inheritance tax. So we're just still going to class the property as being in your estate and we will charge you inheritance tax on that. So even if you've changed the title deeds and it is all in your kids' names, if you've not paid that rent to your children, market rent, then it would be classed as a gift with reservation and there would potentially be inheritance tax still on that. And that goes for any gifts. And it's the same also for care fees and local authority. So a lot of people think that you can give away your home just before you go into care, and actually then the local authority can't use your home as a way of paying for your care fees. Well, actually they still can. They have the legal right to go back and look at the gifts you've made to see if you purposely tried to avoid paying for your own care. So again, that won't necessarily work. Okay, so that's the questions that have come through there. So just to let you know about our next webinar, which is coming up next month, 12th of May, at the usual time, 11 AM on Wednesday. And this time we're going to expand on some of this inheritance tax planning by looking at some of the legal documents that you need to get in place to, again, protect your wealth. So we'll be looking at things like trusts, going through wills, lasting powers of attorney. So all the right legal documents you should have, the key ones you should have, that will mean your wealth goes to the right people. Because the problem we find quite a lot is that having a standard will is great, but there's a lot of implications and problems that could arise, meaning that actually still the people you thought were going to inherit your wealth don't. So yeah, please feel free to register for that. There'll be a registration link in the email that comes out to you later on today. So yeah, that's it for me for now. Thanks a lot for your time. Really appreciate that. I hope you found it useful. If you've got any feedback or any further questions that you think about later, do feel free to drop me an email or give me a call. Our website details are on there. There's lots of articles under the news and views section around inheritance tax, pensions, retirement. You can have a search through and look for that. But yeah, until next time, take care and thanks for attending.